stocks that he's been right about, that other people might have been wrong about. And so super excited to be with Ram today from Lumida Wealth Management. What's up, Ram?
Hey, Amit. Great to be here. Big fan of your content as well. Love your curiosity and your interview with Vlad on Robinhood. So it's great content. Keep it up. Thank you for having me.
Thank you for being here. So I think let's get started into this. This is nice to have you on the channel because I don't think we've had someone on the channel that not only is a CFA, but also you're the CEO of Lumida Wealth. And I'm reading right now, Lumida is a digitally native SEC registered investment advisor specializing in alternative investments and digital assets. What does that mean?
It's a mouthful. Well, we're a private wealth advisor. We're trying to disrupt Goldman Sachs, venture-backed startup. I've had a couple of decades investing and building businesses, including at Merrill Lynch, where I was there for over a decade. I looked around and I said, investing is broken. The investment management business is broken. They have a lot of fees, hidden fees. They're not fiduciaries. They charge for commissions. They don't have skin in the game, and they really don't think, right? If you look at the Merrill Lynch US 1 list, which is their high conviction stocks, their best ideas, it's underperformed the S&P 500. If you look at Goldman Sachs, they had Apple on the conviction list. It's also underperformed. And that has to do with conflicts of interest, right? If Morgan Stanley's banking Elon Musk, they're always going to have a buy rating on Tesla. So, I was there. I saw how the gunk worked. I took a step back, built a few businesses investing in a couple different categories. And I said, there's a real interesting opportunity here. I'd want to build the investment management firm that I'd want for myself because I couldn't find it out in the market.
And so you guys have raised venture funding for this firm.
Yeah, Howard Linsden was backed us. So it was one chat, one conversation over coffee. We didn't shop at all. We had Howard and I are both non-consensus investors. When I sat down with Howard in 2021, this is a peak of the market, right? Howard's a venture investor, and we're at the Crosby Hotel in New York. And, I allocate to venture capital. I'm a cross asset class investor, believe in alternative investments as a role in the portfolio. So I said, Howard, how, when you have price to sales of 100x on the SaaS companies, this is in the wake of like Zoom, everything else through the charts. Right. And he said, Ram, I haven't done a deal in 2 years. And I said, I'm in. So, we had an alignment of values and thought process. Hit it off right away.
And how did you even get to be in the same hotel with him?
So, I joined Twitter in October 2008. And at the same time, I joined StockTwits, actually. We're trying to make sense of the financial crisis. I didn't mean Howard through that. But Matt Ober, who's a close friend, I know Matt when he was at WorldQuant. Now, WorldQuant's the biggest pod in Millennium. Millennium is one of the most successful quantitative hedge funds of all time.
Yes, correct.
And WorldQuant was an investor in my prior startup, which I exited to Cross River. And I knew Matt at Third Point as well. So we, known each other for a while, and Matt actually connected us with Howard. We had breakfast together and said, look, let's do this. Let's go build this. Let's have some fun together.
So you had a startup before that you exited.
That's right.
And what was the startup in a nutshell?
It's called Pure IQ. I got the t-shirt on the floor here somewhere, but we sold data analytics to credit hedge funds and including other players too, including like the SoFis of the world and their competitors. So, we recognize that fintech lending was going to go to the capital markets. And so you need analytical tools like a Bloomberg terminal to figure out what fair value is. So, these are businesses that have been around the hoop for a long time. So, it's not
so
like
you're kind of like a big deal in the world of business. I mean, exits, raising venture capital. This is like serious shit. This is not easy to do.
I love investing. I love building businesses. Nothing else I'd rather be doing. I've been doing this for a long time. I enjoy it very much. I don't watch enough Netflix shows. I watched Breaking Bad after 6 years after its last season.
It was the best show I know, right? Breaking Bad is the best.
Got to be the best artifact humanity's created on Netflix. I'm convinced that is high art.
Yes, I love it. I love it. Okay, cool. So let's get into a variety of topics. I have a bunch of things I want to talk about.
Sure.
I think first I want to talk about your investment style, the investment approach Lumida takes and looking at the public markets, because you guys care a lot about qualitative analysis, but also quantitative analysis. And then we're going to start with SoFi, and then we'll go to the Teslas and Palantirs of the world. So yeah, what's your investment approach?
Yeah, so high level, look, we're cross asset class thematic investors. So that means we're investing in distressed commercial real estate. We're investing in venture capital, other asset classes. But as it relates to public equities, let me double click there. So when we first built Lumida, by the way, I talked to all the providers of software to RIA, and all their products sucked, right? I'll give you an example. Morningstar, They have a flagship value product, flagship growth product. Their top holding in the value fund is Berkshire Hathaway, which is really Apple. And the second holding is MasterCard. And the growth fund, their top holding is Apple. And the second position is Visa. I'm like, these are the same thing. And they're all consensus ideas. So first off, we're non-consensus thinkers. Contrarian is another way of saying that. That's one. Two, we're thematic. What does that mean? We're trying to identify secular trends that are 10 years long, so the wind is behind our back. Number two. Third, I want to own factors. Factor investing is a core part of what we do. So there are factors like quality, value, momentum, earnings yield. And I want to have a portfolio that is indexed to factors that statistically have a long run average excess return. And I can show you an example later on to make that more concrete for you. And then finally, let's pick an example. So, we had a thesis that the best way to play the rise of AI was at the semiconductor layer, not the application layer, the LLM. So last October, we were scooping up Broadcom, ASML, NVIDIA. So when we find that theme, let me share a screen here, just make it very concrete for everyone here. We organize our themes, using technology. And, so here's a spreadsheet that captures a variety of themes, the dozens and dozens of themes. Here's a theme. It's called data center. So every theme, I want to know a couple core ideas. I want to know, how much does this theme cost? What's the valuation of the theme? So I want various valuation statistics, like, for example, PE ratios, PEG ratios. That's one.
Right.
I also want to know, what's the earnings growth on that theme? So if I buy this theme, this basket at this price, what's the earnings growth on that theme? So we have that information here. And now I want to know, what factor exposures does this theme have? In fact, I want to know the percentage of stocks that have certain factor exposures. For example, in the data center, you can see 71% of stocks have positive revisions. I like that. In fact, of all the themes, data center is got the highest level of positive revisions, beaten perhaps only by streaming services. So now this is how we orient around the world. We're going to the top of the mountain here, and we're looking around us and try to identify what ponds to fish in.
Right.
Does that make sense?
100%. And do you think firms don't do that as deeply as they need to? And it's kind of just like, let's buy Berkshire just to buy Berkshire.
People generate a lot of research, especially on the sell side, but the synthesis of that in a disciplined investment process that's not committee run is difficult for people to do. It's very difficult. And by the way, when you apply this process, it'll tell you to do funny things. Like I bought Build-A-Bear, APEI. No one knows what the hell APEI. This stock is up. This is on our top 10 stocking stuffer list.
Build-A-Bear is public?
Build-A-Bear is public, right? So this stock went up 33%. This stock is up 30% year to date, right? APEI, they provide education to nurses, and they're up 100% in the last 5 months. Or Hershey's beating QQQ. So,
you're in Hershey's as well. My friend Chris Patel is in Hershey's. Interesting.
Yeah. No, Chris is great. So, think about it this way. Like, imagine you were at Merrill Lynch, Goldman Sachs, or JP Morgan, and you meet at your weekly, investment committee, and you said, "Hey guys, I got an idea. I want to buy Build-A-Bear." You're going to get left out of the room, right?
Yeah.
This herd mentality applies to investing. Investing is a social process. And by and large, 80% of investors outsource their thinking to someone else.
That's right.
Original thinking is hard.
And so to put a bow on this, essentially your differentiated approach is like thematic, nuanced understanding of the details. And in this business, my understanding of it, either you're building like a brand on finance media or you're building a wealth management firm, you are only as good as your latest idea. So Kathy has been able to raise billions because she got Tesla right, and some of the others might not have been that well, but she got that one right early. Dan Ives with Tesla, Ross Gerber with Tesla. So to you, do you believe your reputation and the future of your business is primarily based on if you can find the next Build-A-Bear when no one else can't?
Good. That's a really profound question. I would say, in wealth management, the foundation is helping your clients achieve their long-term objectives. It's an important duty and special obligation. And we're not traders. We're not a hedge fund, although we outperform all these hedge funds, including Bill Ackman. Okay. But, you have a fiduciary relationship. You're trying to help your client accomplish a goal. So we have some clients that are like, look, I'm near retirement. So we'll say, all right, here's the appropriate portfolio for you. You're going to have a different set of weights. And we don't talk about that much because I'm so laser in on public equities. Other people on our team that do trust, tax, and estate, and they'll, you know, we'll find a different kind of portfolio to accomplish the goal. So I don't think we kind of live and die by the latest idea, but you know, that's the kind of paranoia that keeps me going. I'm always trying to second guess myself and balance conviction with humility.
Okay, let's start off with Tesla. Let's talk about that because you've been pretty vocal on Twitter since the beginning of the year that you think there's problems with Tesla. You are one of the only, I know there's a lot of bears on Tesla, but one of the only ones that gave a lot of quantitative research to really substantiate your claims. What did you see at the beginning of 2024? Or let's start with this. When did you start getting more bearish Tesla? And then why do you think the stock is down 30% year to date?
Great question. So I would say summer of last year is when I started to get bearish on Tesla and Apple. And I'll share my screen. I'll show you exactly why. We'll start there. Then I'll move to, you know, Jan 1. So on this screen here, you're going to see watch list of all the Mag 7 names. And I've hidden, don't look at the ticker column on there. We're doing a little experiment here, right? So we've got the PE
Can you zoom
ratio.
in a little bit, Ram? Just a little
Yeah,
bit.
sure. Let me zoom in here. So
Perfect.
let me know if you can see that better. Is that better?
That's perfect. There you go. Yep.
All right, great. So let's take a look at a few columns here, right? We've got the PE ratio. Okay. We've got next year's earnings growth. We got the PEG ratio. Okay. So when you buy a business, you're paying a certain price and you expect certain earnings growth out of it. Now, if you were to look at these numbers here, I'll sort this by earnings growth. That's what I've sorted here by. The earnings growth, I think, is crucial to understanding a business.
Right.
Which business, and you can look at these other metrics too, including valuation. Like if the earnings growth is high, but the valuation's high, then maybe it's overpriced. So if you were to look at this data, these three columns, what would you want to avoid? Which rows would you want to avoid? You got rows 1, 2, 3, 4, 5, 6, 7, 8.
I mean, the ones that are red would be the ones to avoid a little bit. You know,
you want to avoid the two on the bottom.
Yeah.
By the way, so that's Tesla. Guess what? Tesla is also the most expensive name in Mag 7, and it's got declining earnings growth. Not a pretty combination. The PEG ratio also. So the earnings growth doesn't justify the valuation. By the way, the top one here is NVIDIA. Right. Okay. And there's Apple. So we, you know, Jan 1, you know, I went short both Apple and Tesla.
Oh, wow.
What I saw at the turn of the year was another chart which shows the change in long-term earnings growth. And I will pull that up in the background. But the other part of it is it's not just, you know, you raised the great point in the introduction. It's a qualitative and quantitative. And I'll say this, qualitative is actually more important than the quantitative. The quantitative is important. We just did that, right? But when I'm looking at a sector or a business, it's important to start qualitatively. I started my career in management consulting where you map out categories, industries, try to figure out who's got a moat, who has a competitive advantage, who is the dominant leader taking market share. Those are the things I like to look for because they're power laws in investing and in business. There's usually a dominant leader that owns a category. There's Coke, and then there's Pepsi, which is a distant second, then all the rest. There's McDonald's, Burger King, then all the rest. I guess Chick-fil-A is on the rise now, right? But you get the idea. You want to find leaders. Now, what happens is when you have exceptional performance, it attracts competition. And what we're seeing in the EV space is what we saw, you know, in the 80s and 90s. You know, Honda, Subaru stock went up like a couple 100%.
Right.
And then other folks got on the market and competition shows up. And competition means price competition. And it means margin compression. And it means consumers win. So, you know, I saw that qualitatively. I saw that NVIDIA was starting to enable other players and equip them with, you know, AI tools to enable full service driving. So
essentially you were long NVIDIA, short Apple, Tesla to start the year.
Yeah, we're long in NVIDIA, Meta, and Google. Those are our three holdings in Mag 7. And this is another chart I looked at, and I'll put this on the screen here. It's the long-term earnings growth expectation. So I posted this on around Jan 1 of this year. And you can see, so Jan 1, this is like top of the year, this line here between 23, 24.
You can zoom in on that one too.
Yep, let's zoom in here. You see that? So that blue line is NVIDIA, right? Okay.
Right.
So I'm looking at this on Jan 1. I say, I might want to own NVIDIA. By the way, there's more qualitative analysis there too. Like we think NVIDIA is a class unto itself.
Right.
Okay. It's like Hakeem Olajuwon playing basketball with high school kids. You know, he's just playing the game at a different level. Okay. So I look at that and I say, qualitatively, we love the business, dominant market position, and the ROI on those chips is high for the buyers. So then I look at this gray line. That's Tesla. Okay. That's long-term earning growth is the lowest of this category. I said, gee, that doesn't look too good. And I have been, Apple's right behind it. But Apple around this time was more expensive than NVIDIA, which makes no sense.
That's correct.
Right?
It makes no sense. Not at all.
Right. And that's part of the relative value work that we do as well. I'm always saying, gee, what's my best opportunity cost of capital? Like the reason why we didn't buy Lululemon on the dip is I can buy other semiconductors that are cheaper on theme, going back to thematic investing, right? The future is semiconductors, CapEx, receivers, and growing faster. So one of the things we did 2 months ago is we sold almost everything in our portfolio that was more expensive than NVIDIA. The rule was you can be more expensive than NVIDIA, but you better grow faster than NVIDIA, and nothing does.
Wow.
Right. So cleaned up that portfolio, which helped protect us.
Okay, let me ask you this question then. Going back to qualitative on Tesla. So the bulls will say FSD is something that is a moat in and of itself. There's really no competition for that. Elon Musk is a visionary who can see the future and really, build something special. Optimist. I mean, there's a variety of different bull case arguments that really the argument is kind of similar to Amazon in 2014. You didn't know what AWS and what they were in prime, but like it was expensive. But if you bought it, you did well. Why isn't that true with Tesla at $170?
So first off, look, Elon's a visionary. What he's accomplished is extraordinary. There's no doubt about that. That's one. Two is, look, I'd add to your bull case. I think the bull case is humanoids. If humanoids hit in a material way, then yeah, I think Tesla can do well. But they have to maintain a dominant leadership position too. If they're humanoids and you're in a price competition game with which a bunch of other players, including Figure in Texas and China, which is in the humanoid race, and NVIDIA, which is enabling other humanoid players, then that game doesn't look interesting. So the bull case is humanoids. EVs is not the bull case. Look.
Why?
Here's why. You've got China producing EVs at $11,000 price point, and they're high quality. On the low end, the quality, they offer value. On the high end, they're also high quality. These are luxury EVs, are really nice EVs. Now, yes, we got 100% tariffs that are going to help protect, but overall, though, you can see that Tesla needs protection to compete and win. And when you see heightened competition, when you see competitors meet at an intersection, you want to run away. You want monopolies. That's what I look for, right? Google, NVIDIA, Meta, these are actually monopolies that don't face real competition, and they're cheap. They're much cheaper than all these other businesses.
What about FSD? Why is that not monopolistic?
So, Tesla today is still rated level 2. FSD, the latest version, looks quite promising. It's better, definitely much better, but it's still not level 3. The only automobile manufacturer that's rated level 3 globally is Mercedes.
Right.
Mercedes got a level 3 FSD. That's something people don't talk about. By the way, Mercedes PE ratio is like 5.6. So what's my upside downside on this? Right. I don't know Mercedes. I think it's interesting. I look at it quite often. We're not there yet. But that's the challenge. FSD will work at some point. I think the issue is it's going to work for a lot of people around the same time. Tesla's best hope is that they can be the picks and shovels provider to other automobile manufacturers and be a SaaS play. I believe they've got one in the pipeline, one dealer in the pipeline. And the other is that if they can get SaaS revenue on FSD, that would be very compelling. I'm willing to change my mind if I see those two things flip. But you also need, Kelly, FSD tried to open
It's not perfect yet.
It's not perfect yet. And the standard needs to be high. By the way, China's got another edge because their safety regulations are lower. They're willing to sacrifice a little bit more human life on the margin to get AI better. Okay. So that gives them an edge. They're going to roll out FSD faster than the United States.
Do you think Elon being political is a threat to the company and just tweeting?
Really interesting. That's a really interesting question. I think, he's definitely, it seems to me, in the political crosshairs of the current administration. That seems to me to be the case. So it helps and hurts. In a Trump administration, I would presume that he has certain advantages that he probably doesn't have now. However, all that really matters is earnings growth, right? So there's primary considerations and then secondary. I put this in the secondary bucket.
Okay. No, that makes sense. I think that's a fair bear case as well. And I think it's so important to analyze the bear case. Here's the last question on Tesla. Do you think, because you're part of FinTwit, you're part of the social media universe, that the bulls are not receptive to the bear case and they're too?
Yeah,
they're too intertwined into their own narrative.
It's an echo chamber. Like, and I've seen this before. Like, I'm instinctually contrarian. When I see a stock on Twitter, instinctually, I'm assuming it's a bad idea. I want to take the other side. That's just how I'm built. And so when I see Tesla and I see that, I've been blocked from people. I think I engage intellectually in a fact-based manner. I've invited people to come on and talk about SoFi. And then immediately I'm blocked, say, SoFi 007 girl, would you please join me in a podcast? I will give you the floor. You can have the opening and the closing. And I get blocked. I don't know, right? So there are bubble chambers. The other part about it is this, I think investor relations has smartened up to social media.
Yes.
So, I was an investor in Lending Club back in the day. Company went public and their stock started going downhill, and they retained a media agency called Atomic. And so I got to learn how IR works. Give you a nice, pretty deck, a nice, pretty story. They dress things up. Suddenly adjusted EBITDA starts to show up, right? And there's crisis management. They'll start placing op-eds and articles and other positive, sounding vibes. And I'm sure that's happening in social media. Like, I see Twitter accounts that make no sense. Like, who wakes up in the morning identifying their life purpose with Tesla and there's a car and then nothing else? And it just doesn't make sense. Like, who are these people? I would love to meet them. And there's more to life and humanity than like a single stock.
No, that's fair. That's fair. Okay, let's go on to SoFi. So in terms of SoFi, I have seen you engage, I would say, relatively fairly with the SoFi bulls for the past couple months. You've obviously been right. Stock has not performed, and the bear case has started to become clear to a lot more bulls. We'll start off with the easy question first, then we'll get into the nitty gritty of it. SoFi is pitched to me as a consumer banking company that has a tech side of the business that is what's supposed to give it a SaaS multiple, which is what differentiates it from JP Morgan, Bank of America, et cetera. What is your problem with that thesis? And do you think currently SoFi is undervalued at $7?
Second, no, it's definitely not undervalued. If it rallies close to 8, I will then put on a short position. I have no position now. We've made money shorting SoFi 3 times. We're in it all on Twitter too. But no, SoFi should be valued on tangible book. So the question is, what's the multiple on tangible book? If you look at Citibank and Barclays, I checked
1, right?
Well, actually less than 1. If you look at Barclays and Citibank, their price to tangible book value a few months ago was like 0.6. Banks are really cheap right now. So maybe you give SoFi multiple for all the points you raised, that it's faster growing, it's technology related. Fine, maybe you give it a 1, let's say. Okay, I don't think it gets a 1. And we'll come back to why, because of the personal loan book, which is like an albatross around the neck. But the issue with the technology play is this. Like, I grew up at banks. I've sold software to the FDIC. I understand bank procurement processes. Okay. Banks will not buy a core like Technisys that was originated in Latin America. That's one. Okay? They will not do that. They're going to buy cores like Fiserv and FIS and Jack Henry, which are the leading providers of cores. They're oligopolies. They're wonderful stocks and businesses, by the way. I hope to buy the dip on those. But and it shouldn't be the case. I would want to see competition for these oligopolies. They're entrenched and they're dinosaur companies. It's like I'm rooting for like Technisys intellectually in this other way, right?
Right.
But regulators won't let banks buy them. By the way, SoFi's own core is in Technisys too. Now, Galileo is different. Galileo is payments, right?
Right.
It's very difficult to change out your core. Like, the switching costs are high. The risk reward just isn't there. It's a very long sales cycle. And I think it's a 0 just because, again, banks won't adopt it. All their customers for Technisys are not banks. The companies like Dave, fine. I own Dave. Dave did pretty well, but it's
like
not
Chime or stuff like that.
Right. And that market is not a growing market. So I want to swim in the ponds that are growing, where the TAM is expanding. Like, who else? Okay, so they're going to get Varo, perhaps. That's not a growing market.
So you're saying SoFi is not going to be able to sell Galileo and Technesis to the JP Morgans of the world. You're saying that's not happening.
Absolutely not JP Morgan. JP Morgan spends $13 billion on tech spend each year. They will not. I can guarantee you, I will give you 10-1 odds. JP Morgan will neither will American Express, neither will Citibank, absolutely not Bank of America. So their play would be to deploy, I suppose, in the community banks or regional banks. Well, let's talk about regional. The regional banks are on their heels. They need to conserve liquidity. They're not trying to spend on CapEx. Right? If your community bank, again, they're exposed to commercial real estate. Who's the motivated player here to say, like, I'm going to change out my banking core?
Okay, so why do you think management is saying that, or basically implying, even if they're not explicitly saying, that they deserve a tech multiple with this SaaS play? Like, what is the incentive there?
If I were Noto, I'd be doing the same thing. Noto has the right vision, by the way. I applaud the vision. The vision is accurate. The vision is called own your customer, have multiple touch points. By the way, that's also the vision of every other fintech. It's not like an original. If you go to McKinsey, they'll charge you $1 million and sell you that vision, right? So it is the right vision. And to their credit, I want to be balanced here. They have executed better than every other fintech player on that vision. Lending Club did not.
Yes.
Okay.
Yes.
They have the deposits. They acquired the bank license too. But here's the thing: when you own a bank, you get valued as a bank, no matter what. We have yet, JP Morgan's got a ton of technology, still valued as a bank. JP Morgan has a very large, one of the largest e-commerce payment transaction businesses in the world. Okay. But JP Morgan still gets valued as a bank. No one cares. They say, you know what? You're a bank. Markets summarize. They say, what's your identity? Oh, you're a bank. I'm going to value on tangible book value. And I might give you a premium based on the quality of your franchise. JP Morgan is one of the best banks, in the land.
Yeah.
So they get the premium. Their ROE, they earn that premium though, because their return on equity is 15%, higher than any other bank in the land. They make more money for their balance sheet than anyone else. And JP Morgan can into personal loans like SoFi. All these banks choose not to do the kind of lending that SoFi does because it is risky. I mean, I personally would not extend a $25,000 loan to an individual that has $125,000 in income.
Right.
An unsecured loan. I can buy many assets in the world that are less risky than that for a comparable coupon.
So let's get into that. The delinquencies default part of this game. Do you think management is, because what I've heard is that they're being extremely conservative in their guidance around this. Do you think that's a legitimate risk, or do you think Noto and the team are strong enough to make sure nothing goes
crazy? This is a significant risk. This is a factor that's outside of management's control. Look, I grew up in consulting. I had clients that were credit card issuers. I had a data analytics business focused on credit risk. So consumer credit risk is something I know very well. I interviewed my friend William Black, who was head of consumer securitized products. He would issue SoFi bonds, right? Wow. So this is a world I know pretty well. I'll take consumer credit risk. When DQs go up, it's like the genie's out of the bottle. It's like a fire. It's like a forest catching a fire, and it just keeps burning. You can't we're going to stop it. Or we're going to intervene now. You can't. You already made a loan. It's easy to make a loan. It's hard to get it back. And DQs now are approaching 2008 levels. And so what is a bank? A bank has more leverage than a hedge fund. They're 10 times levered because they're borrowing deposits to fund their assets. So SoFi's got $15 billion of deposits. They're not originating new loans now. Okay.
Yeah.
The capital reasons why. Okay. So they've got these loans. They're funded via deposits. They're trying to capture the spread between the cost of the funding and the return on those assets. Okay. Now, last quarter, we saw the first time negative fair value adjustment. I've been waiting for these. Now we see it. So what you see is this. When you see negative fair value adjustments, they don't stop. They don't stop for a while. So next quarter, you're going to see it. And the quarter after that, you're going to see it. And the quarter after that, you're going to see it. And what does that do? It reduces the tangible book value of the company.
Right. And so your argument is that implicitly they're showing us that delinquencies are going up in the company.
They need more transparency. They give you a statistic or two or three sometimes, but what we really want to see is vintage loss curves. What that means is you want to see by year for the new loans originated. You want to see a curve that tells you are DQs, delinquencies increasing or not. So if you look at a credit card ABS master trust file, you can see these curves. So we know, by the way, just look at earnings, look at Discover, look at any other, DQs are going up. And SoFi said that as much, but there's a lot of ways you can play funny games with the numbers, by the way. So if I give a client a loan modification, I can say, hey, you're delinquent. I call you up. I say, look, you're in forbearance. You don't have to pay us back in 3 years. Sorry, 3 months.
Right.
Now I tag that loan as current. I'm not saying SoFi is doing that or not, but all I'm saying there's so much opacity. And this is where we need like a better regulation, more transparency. And I've asked SoFi, just publish your delinquency curves, number one. Second, publish your fair value methodology. And others have, like Opportune has a very clear fair value methodology.
You're saying that's not unreasonable to ask them to do that?
No, Opportune has published a fair value methodology. Like, by the way, from what we do know about how they value loans, like the key thing you want to do when you value a loan is you got to figure out like what is the discount rate you apply to this pool of cash flows. That's what valuation comes down to. So their discount rate is slightly higher than US Treasuries. Does that make sense? It's an unsecured loan. You know, mortgages have a discount rate of 7%, and that's secured. That's not just secured, it's senior secured. That's first in line to get paid back. A discount rate of 7%. How is SoFi south of that? Now, by the way, if you said SoFi, let's use a higher discount rate. Maybe it's 8%, 9%, 10%. What would that mean to the fair value adjustment for SoFi's for their loan book? It would be a significant negative impact that would go straight to the tangible book value. And that's why, you know, if you talk, there's no institutional owner of SoFi. If you go to you go to the 13Fs. We look at the 13F filings every quarter. No one owns SoFi. Are they really missing this? They're on Twitter. Are they really missing the SoFi story? Or
do you think the banks don't want to own SoFi because they're scared of SoFi?
No, banks, JP Morgan Asset Management owns Goldman Sachs stock. They're not scared. They're investors that get bonuses paid on making money.
Yeah.
Right. Yeah. They're not trying to, like put SoFi in the penalty box. In fact, Amex had a chance to acquire SoFi. They declined. That's inside baseball, by the way. So they looked at the books and they said, why would we want to own this business? JP Morgan, that opportunity flow. This is like 5 years ago, by the way, not more recently, that kind of anecdote.
Do you share some of the concerns? So I want to ask you about Robinhood in a second, but I've used SoFi's app and it's just not a great experience. Do you think that?
Right? I was actually going to sign up I dead serious. I wanted to sign up because I didn't need a better bank. Go ahead. Sorry.
Yeah, no, I was just going to say, have you looked into the app as well? And are you kind of bearish from?
It's a good, I think product quality matters. Look, Robinhood is delivering on the SoFi story, right? I know you're a big Robinhood. Aren't they though, from a customer experience? I mean,
well, that's what I realized a year ago, and I saw kind of where the puck was going. I was like, this app sucks. It took me 30 seconds to log into SoFi, and with Robinhood, it takes 0.2. It's like
right, yeah. So SoFi built their business via acquisitions, and that helps you grow quickly, helps you deliver on the vision. And their competitors did not do that. I give SoFi credit for that, but it comes with the hangover effect of you compromise the technology experience. So Robinhood was all in-house built. I don't own Robinhood, by the way, but I'm merely saying that Robinhood is now executing, I believe, on the vision that SoFi had set out to accomplish.
Okay, so one last question about SoFi, then we'll go to Robinhood for a second. Why do you think retail loves the stock?
I think part of it is that social media, investor relations, marketing. Look, I'm very skeptical. I try to find reasons to say no, and I believe my hypothesis is that, look, I see these NPC accounts. They're identified so I don't know how many are real. I know some people are. I met friends that are SoFi bulls actually. Yeah. Because they respond to me, they DM me, and then we get into Zoom. Like, oh, I'm glad you're a real person. Thank you. What do you think about those people? And have you ever talked to them? No, I've never talked to them. Okay. So I think part of it is like storytelling, like the people like data-driven investing who make these incredible arguments, and they seem so persuasive. And you see a nice chart going up and to the right. And you're like, oh, I just want to believe. And humans are susceptible to stories. And that's also why you should be avoiding those, right? Story stocks generally underperform. You want to own ideas that are non-consensus, that are contrarian. You want to lead the market. I'm owning energy services now. Who the hell is talking about energy services?
Yeah, well, I think you see what's happening with AI and that energy is needed for
That's right. That's right. Exactly. Nuclear energy. Those kinds of plays are far more, or uranium. Those are far more interesting plays. I got a secular trend, and some people are talking about that now. Goldman just started talking about that, but they made so you want to focus on those left trapped opportunities. When everyone's in, there's no one else to buy. It's the thing people miss. So when they see a bunch of people talking up SoFi on Twitter, they think that's bullish. It's actually the other way because they already bought in. Yeah. So who's the marginal buyer? And if that person changes their mind, then they become the marginal seller.
Yeah. And you know, data-driven investing, he's a friend of mine, friend of the channel. I think he produces phenomenal research.
His content. I like his content. I wish he hadn't blocked me. I don't know why. I respect his content. I appreciate it.
Yeah.
I would welcome a debate with him and an analyst. That you can.
I think that's actually a great idea, dude, because I respect his analysis so much. I don't agree with him on everything when it comes to SoFi. I think like a debate that I can moderate between you. I think that I might pitch that to him.
I wouldn't even want to be in that debate. I would probably sit back, eat popcorn. I'll give you an analyst that you can put on the show, 1 or 2 different analysts, like a professional sell-side research analyst. Most sell-side analysts aren't worth their salt, but some of them are exceptional. And I'll give you 1 or 2. And by the way, after I posted about it, my initial post on SoFi was more like, I wasn't even like, hey, I'm sure. So I was like, hey, I don't know why people are so excited about this. Here's some concerns. I was late October after earnings. It was $10 and change. And the analyst started reaching out to me and I learned more. And I said, wow, this thing is actually worse than I thought. And I got some things wrong in the initial analysis, which people like DDI posted out. There were some things I got wrong, but the main of it, the broad brushstrokes are accurate in terms of the bear case.
Okay, let's quickly touch on Robinhood. Bullish, bearish, how do you think of their new 3% credit card that they want to be able to expand given your experience with credit risk? And stock's done well. Bank of America just put out a $24 price target. They believe that there's a bull market and Robinhood is kind of the best way to play it given retail is going up. Do you see that as a bull case, or are you a little scared of Robinhood as well?
So as I mentioned, I'm constinctually just contrarian. And when people talk about a stock, I kind of don't like it. I like stocks that I thought of myself. If you look at the Lumida stocking stuffer list, like no one is talking about API or Build-A-Bear or Hershey's, right? So that's where I like to play. And, if I feel like I read of a stock 100 times on Twitter, then I don't want to be the last money in. Yeah. That's one. Second is I don't like pro-cyclical businesses. That means businesses that go up quickly in a bull market and then they get hurt in a bear market. I want businesses that have recurring revenue. I think on the credit card, I think it's hard to make money on that business, and the valuation of that business isn't terribly attractive. I think in a bull market, Robinhood will do well. In a bear market, Robinhood gives back quite a bit. So it's better to trade it than own it.
That's fair. That is fair. Okay. Palantir. So why are you not all in on Palantir? I'm very confused about this, Rom. Tell me what's wrong with Alex Karp?
Sure. First off, look, Alex Karp is a phenomenal CEO. He's a visionary CEO. Their VCs are very capable. I love how they're selling to the U.S. government. They're very good at selling to the U.S. government. The U.S. government fawns over Palantir. I know this from personal experience selling software to the FDIC. It's like it was us, Palantir, and someone else. And like Palantir. Okay, so that's the bull case for Palantir. I get it. I'm not, and I love the AI theme. It's on theme. Right? Going back to my framework. Okay. My issue with Palantir is valuation because and here's why. So let's take a step back now. The number one driver of stock price returns, if you do like a regression analysis on a bunch of different factors, is the multiple expanding.
Right.
That's the number one driver. The number one driver explains 50% of stock price returns, by the way. The number 2 driver is earnings growth, and that's clocking in at like 30% or so. Okay.
Yeah.
So when I look at Palantir, I think this is a consensus name that is fully priced. And further, you're seeing smart investors like Peter Thiel that are selling their position. It's got a 62, forward PE. And when I compare Palantir to another investment I can own, like NVIDIA has half of that PE, like mid-30s PE. NVIDIA is growing faster. Palantir's got to buy GPU compute from NVIDIA. Why wouldn't I own NVIDIA instead? So that's very simply put. I'll pull up my factors here, just make it very concrete for I mentioned these factors earlier. I'm going to show you a little bit of my special sauce. I've never shared this before. It's an internal factor model we have.
Someone said, Jeremy, friend of the channel, he says, "Oh, Rom, you're just bullish. You're just in the closet still."
Look, I try to it's important to find the bull case and the bear case and talk yourself out of your own position in a way.
Yeah, 100%.
Try to re-underwrite it. But if you look at like Palantir on their factors, the earnings yield, this is a valuation. This is all in Z-scores. These are standard deviations. This is one of the most powerful factors, as I mentioned, of driving forward returns. It's negative. The growth is high. Surprisingly, this factor, growth, is overrated. This is revenue growth. Stocks that have rapid revenue growth tend to underperform other stocks. You want earnings growth.
Wow.
Profitability is another major factor. It's flattish. Okay.
They are profitable though. Do you give them any credit for?
Yeah. Look, this credit you can. Let's take a look at the.
And I know it's net interest income that's making them profitable, but it's one of the only profitable AI plays out there outside of Microsoft.
And net interest income won't get valued as richly in some of the parts. If you look at where it is to analyst price targets, by the way, I think analysts are not worth their salt on average. But I like to try to see where is this versus market. It's full. It's at best, I think it's fully priced. If you look at right, and of course, it's when it shot above this black line is average analyst expectations. When it shot above this,
can you share that screen? I think you're on the wrong screen.
Oh, sorry about that. Thank you. So let's go here instead. So here's let's zoom in there. Here's Palantir in blue line versus average analyst expectations, and you can see that whenever it gets above average analyst presentation expectations, it pulls back. You can see that in kind of the red here. Yep. So at best, I believe it's fully valued. You've got seller ratings. You got too many sellers. It's rare to see that many seller ratings. Again, be cautious about relying on analysts, but in this case, I do think the analysts are correct. When I compare it to my factors as well, there's a lot of short interest, highly shorted stocks on average underperform. Hedge funds don't like this too. Hedge funds on average statistically make money. That's why they exist, even though they're highly overrated. It's got momentum. Momentum is a real phenomenon. I want to own stocks that have momentum, by the way. So
what is momentum? Do you mean thematically it's in AI? That's the momentum?
So momentum is defined statistically as stocks. If you look at the last 12 months return, minus their 1 month most recent return. Okay? And then you rank order those stocks. Stocks at the top of the list, on average, continue to outperform.
Right.
Winners keep winning, losers keep losing. That's what momentum is. Momentum is a real force. So the best case for Palantir is momentum. And that's been working out. The thing about momentum, though, is every now and then momentum turns around and it stops working. It's hard to know when that happens. I like to look at the momentum ETF, MTUM, periodically to get a sense of that. Here's the MTUM ETF, and momentum's overbought. It's quite overbought. If you look at where it is versus the 200-day moving average. By the way, I'm not even sure. Go ahead. Yeah.
I didn't even know there was a momentum ETF.
There are a few different momentum ETFs out there. MTUM is actually has fairly good companies in there. And by the way, Palantir is not even a top weight.
Yeah.
Okay. So, but there are other momentum ETFs you can look at. I look at the momentum factor, and what I see in that is that it hasn't. There's 4 times in the last 10 years momentum has been this overbought, and we're living one of those moments now. So what happens is when momentum is overbought, it tends to experience mean reversion. So momentum stops working, right? I'm not saying it's going to happen now. I think there's a lot of hype. NVIDIA's earnings are next week. Inflation is coming down. The Fed is easing and will be easing. And it's bullish. Higher for longer is priced in. There's a good bull story out there.
Right.
Earnings growth has been strong, right? But eventually momentum will start to exhaust. And so at best, the stock goes flat. At worst, it mean reverts. And it's very expensive. If you look at the names that report on earnings that are growthy names, on earnings, they drop, right? We've seen that with Duolingo and Team and values outperforming growth as well. So if you take a step back and look at what's happening in big picture, if values outperforming growth, I want to in general lean in that direction. I still own tech stocks.
Yeah.
But I'm doing growth at a reasonable price. I'm doing tech stocks that are cheaper than the Snowflakes of the world and the Palantirs and the Teslas of the world. And they're growing earnings and they have real moats and they have real cash flow and they can buy back their stock. Google just announced they want to get into cybersecurity. Microsoft just announced they want to get into data analytics, competing with Snowflake and Fabric. I mean, when these giant companies, they look around, they say, okay, we need more earnings growth. Who are we going to point a bazooka out and take out their P&L? And Microsoft did this with Borland and WordPerfect and VisiCalc.
Slack to an extent. They forced Salesforce to buy them. Yeah.
Slack, Microsoft Teams is trying to take out Zoom now. So those technology companies have extraordinary competitive advantages, and they're not as expensive as a lot of what I call story or these glamour stocks that you see out there.
So in the context of the actual like AIP product that Palantir put out and connecting LLMs and all this stuff, you're like, yeah, that's awesome. You just don't like the valuation.
Correct. That you nailed it. That's it.
And I'm assuming you don't like Snowflake's valuation either.
I mean, no, not at all. I mean, I look at Altimeter's 13Fs every quarter, and I wrote about Altimeter in November. I said, wouldn't own it. It was like one tweet. And now that thing has just gotten shellacked. And that thing is in a bear market, by the way. I think you fade rallies. This thing is a world of pain for Altimeter. They made a 40% position bet per their 13F on this stock. They took a concentrated bet on this stock. And
they got the other 4 right.
I like Meta. I like NVIDIA. I think Uber and Microsoft are fully valued.
Yes.
So, and those, Uber is quite expensive. Microsoft is at its highest relative value in its own history. You got to look for value. Value actually, if you're an investor, value works. If you're a trader, then, figure out the themes that are working, figure out whether value versus growth is working. Think about whether you're in momentum or reversion. But if you're an investor, again, the number one driver returns is multiple expansion. Like, look at my Build-A-Bear stock. Build-A-Bear is crushing a lot of things out there. Okay. Look at API up 100%. Look at SelectQuote. Look at Dave. Dave was up 500%. Okay. So look at Hero. We bought that 2 months ago. It went up 50% in 2 months. We sold. These are all small caps.
Dude, I did not know this thing was public.
So here's one of the simplest ways. Look at the value. What's the valuation on that?
400 million.
Right. The PE ratio is 8. Yeah. Okay.
And you get a dividend. Wow.
Yeah. So here's what these guys do. They generate free cash flow and they go buy their stock.
Yeah. There you go.
So you have a bid. You have a bid in the market.
Yep.
Okay. So there are different ways to invest. Growth, there's value, there's turnaround, there's momentum, and you need a different part of the brain to do those. And by the way, I recommend that people specialize. Otherwise, you're going to get schizophrenic.
You gotta have a philosophy, some type of philosophy.
You got to have a discipline and a philosophy. I would say, like, right now I'm looking at CVS. No one's talking about CVS. Okay. Let's pull up CVS real quick.
Real quick. How long do you want to hold Build-A-Bear? Is this a trade?
At least until I get long-term capital gains, which is going to be, end of year at a minimum, because I don't want to double my tax rate. Taxes matter.
Yeah.
As long as they keep generating free cash flow, buying back their stock, and the valuation is cheap. But I can tell you the same story for like Crocs, Energy Services, Tidewater. Many, all these names I've mentioned have beaten the S&P and the QQQ. And they're value stocks. Okay. All of them have. It's wild. Now, the stock I'm investing now, if people is TNK. Let's look at TNK. Okay. This is first time I've
let me do the last question on Palantir, then I want to introduce TNK and CVS. For the next 5 years, the next decade, if someone's watching this and they're like, hey, Ram, you really pissed me off this morning, but I have Palantir at a $13, $14 average. I love Palantir. I believe in their bull case. Over the next 5-10 years, are you saying, there's a busted growth story just because of the valuation, or are you saying this
valuation matters? In fact, valuation matters the longer you hold it. Here's a fun statistic. So look at the S&P 500. If you look at the entry valuation and you measure the forward return 1 year out, 2 years, 5 years out, and 10 years out. So all you know is your entry PE or even price to sales, price to cash flow. It doesn't even matter which valuation metric you pick. So in a 1 year correlation, it's like almost zero. It kind of doesn't matter. It's a mild correlation.
Yeah.
In 10 year, the correlation is 90%.
Yeah.
Valuation shows up. And markets, I think, are hyper accelerated now. So, with higher for longer, with higher interest rates, investors are saying, gee, I value cash in hand today versus cash in the distance. And a growth stock, a high multiple growth stock, is a claim on cash flows in the future, in the distant future. That's what we call duration. Right. So a higher interest rate discounts those cash flows. They are worth less than cash in hand tomorrow. Correct. And that's why value's been outperforming. That's why I still own my tech names. I mentioned those, but I got a barbell portfolio where I own these value names that are buying back their stock, generating free cash flow. And the best is if they can compound, if they can get that free cash flow and invest in their own business in a predictable manner. So they plow back their free cash flow and they get a return on that invested capital that grows more free cash flow. That was actually the original definition of investing, by the way. People forgot about that.
So for you, the only growth story, the only way you like even get interested in Palantir is then if they accelerate growth at levels that justify the value.
You would need like 300% earnings growth in a sustainable manner for many years, something like that. I haven't done the math, but the PE, what's the PE, 60 or something? It's high.
Yeah,
I haven't done the math. You need like you not only need sustained earnings growth, and it's just pricey. It's pricey. Look, my opportunity cost of capital versus other positions too. It's important to look not just at Palantir in isolation, but what is the universe of investable opportunities. I can own Taiwan Semiconductor at a low 20 PEs, picks and shovels play, the most systematically important company in the world. Or as a Palantir, I can own the many other names that I can own where the risk-adjusted return, which is a key term. So risk-adjusted return, my upside versus my downside. It's easier bet to make. I can sleep better at night.
No, that's fair. That's very fair. Okay, let's talk about some of the stocks you're interested. You can give me a couple names, some alpha here for the audience that you think is something to just at least look into.
So here's one, we've been buying for the last few months. I'll share TNK. This one ran up, so wait for a pullback. But this is why I'm sharing it. The thing ran up, so I'm not buying it anymore. But it's still cheap. If it pulls back, I will buy it. I'm going to share my screen here. If you look at this thing, this thing's got a 5.3 forward PE ratio. Okay, so they're a tanker company. They provide crude oil and marine transport services. So they put oil in a tank and they move it around the Cape Horn. Look at the stock performance. It's been very strong stock performance. Look at the 5-year CAGR earnings growth, 30%.
Wow.
30%. Okay. Let's look at how it's been valued. Its valuation is starting to improve. It's starting to get a bid. It's still one of the cheapest stocks in the energy category. In terms of its performance, it's done 78% in 1 year, 43% year to date, wow. 24% 3 months. So, people think they need to own technology stocks to make money. It's absolutely not true. I will buy tech when it's cheap. At the beginning of the year, technology was at the 99th percentile of its valuation. Is that the time to load up on technology? No. Is that the time to buy Snowflake? No. Is that the time to buy Datadog, Okta, or these other fantastic businesses? No.
So what is the thematic theme here for tankers?
Yeah, good question. So the theme here is the world needs more energy. We're short energy. We need old energy. We need all of the above energy. And we need nuclear energy. If we have a big focus on energy, not enough energy to go around. The geopolitical risk, we believe, benefits these tankers. They get paid more. If you want the tanker to go around a continent, they're going to get paid more. That's one. Two, it's hard for competition to enter the category. It takes 7 years to build a super tanker in South Korea. Third, the replacement cost of these assets are very low. So you're buying these businesses actually at very low cost compared to if you were to sell all their assets, there's actually implicit value there. And they generate a bunch of cash flow and they buy back their stock. That pattern, I love that pattern. Look at David Einhorn. Last year, he did 50%, I want to say. He's got this one home builder, Green Bricks. It's half their portfolio. It's wild. I wouldn't own that stock now, by the way. Either way, it's kind of like, you should have, I have 30 to 40 different names, by the way. And what do? They buy back their stock with free cash flow, and it's cheap. They create their own exit liquidity.
Yeah.
So I think the areas to look into now are like insurance. So, when Buffett in the summer of last year, he announced in his 13Fs, they bought 3 home builders like Horton and Lennar, a bunch of others.
Yes.
Home builders were, had a few more weeks of correction. They started lifting off. So my thesis now is that with Chubb, he saw they bought Chubb on Wednesday, S&P all-time high, Chubb up 7% that day. Chubb went up again the next day. Insurance is going up. Insurance is cheap. 1. 2, they're making a lot more money. Why? Because all those hurricanes that rolled through the last few years, they allowed the insurance companies to charge more. 3, their stocks have been slammed, so the risks are priced in and the upside is priced out. That's a key concept. So we all know you want to buy low, sell high. Okay. We know we're not supposed to buy high, sell low, which most people wind up doing, right? But you want to buy low, sell high. But how do you know that if the price drops, that doesn't keep dropping?
Correct.
Well, the key is you got to know, are the risks priced in? So Lululemon, okay, athleisure is coming online. China's coming online. People are shopping e-com. Valuation is still pricey. I don't know if all the risks are priced in. Insurance, yeah, the risks are priced in. The hurricanes already showed up. The premiums have increased. You don't see new entrants in the insurance market. It's there's a moat just by having a license in the insurance category. We've had the California wildfires. So I think the risks are priced in and the upsides are not priced in.
Okay, let me ask you this last question, Ram. This is an interesting one. I want to know about companies that are deleveraging their assets. And I know I got to get you out of here in 5 minutes. Any thoughts on Carnival Cruise Line, a company that has a lot of debt, that is deleveraging, refinancing some of the debt? And I mean, down 13% year to date. At one point, this thing was $40-$50. COVID happened, and people tend to be traveling more. Is this a theme or a thematic theme that you can get on?
There is a theme around the boomer spending money. I think it's a very good theme. There's a two-tier economy. We have the boomers, and we have like the 20s and 30s that are struggling. And you can see that in Dollar General, Dollar Store, higher delinquencies, but the boomers are spending money. Cruise lines have done very well. Look at Royal Caribbean. So CCL, I haven't studied closely, but let me share my factor screen with you. Actually, I'll do a quick.
Let's do a live. Let's do a quick
take on this.
And real quick before you do that, guys, Ram's got to go in about 5 minutes, but I'm sharing his X right now in the chat. Please make sure to follow him if you got any value from this, even if you disagree with his thoughts. I think it's the healthiest thing to find someone you disagree with and keep up with them. And then Ram, Lumida, are you taking on clients or anything?
We do. Yeah. We're focused on private wealth. So, high net worth investors, wealth management, trust, tax, and estate as a fiduciary. No, thank you. Appreciate that.
Okay. So if you've got a shit ton of money in the chat and you think Ram can make sure he doesn't fuck up your net worth, LumidaWealth.com, check it out. Give him
Thank you. So here's Carnival Cruise Lines, and let's pull up the factor. So number one, all right, earnings yield is positive. That's good. Okay. It could be better, but not bad. So far, I like what I see. Revisions are positive, not wildly positive, but they are positive. And if you have a variant perception that revisions will be even more positive, which I probably would be, I think boomers are going to keep spending on travel and leisure, then that's some upside there. Leverage is very high, to your point. Okay. That's not necessarily bad, particularly if rates come down and they can refinance. So you've got to do an analysis of their debt. You got to look at the covenants. That's an analysis. We don't have time to get into here. Profitability is negative. That's a mark against them. It's highly shorted. That's a negative too. That shorts are smart. They have some insight on this stock. There could be some kind of issue here. So look, it's a mixed story on Carnival. I'll compare this to like TNK. Just again, look at opportunity cost. Let's compare TNK's factors to CCL. It's going to take a second to pull up here. Look at that earnings yield.
Can you switch the tab?
Oh, there we go. So this is TNK. Earnings yield, significant. It's wildly profitable. Revisions are positive. Okay. And it's got momentum. So what's not to like? I've got quality. I got value. I've got momentum. We like those numbers. Let's go to Carnival Cruise Lines.
Is this your own proprietary software that you built?
Yeah, we have our own in-house software. I used to build these models way back in the day, but we also rent models too and stitch them together in different ways. But this is Carnival Cruise Line. So earnings yield, not as strong. Revisions are positive. That's good. Profitability is negative here. So it's not as strong a story. It could be something interesting here though, but just on the factors, I'm kind of less excited out of the gate. I do like the theme of
the theme of travel. Is that the theme?
It's really like boomer spending, and within that, travel is a part of that. I would say, travel's run up a lot, and that's the issue. So you want to buy these things when they're, dislocated, and out of favor. Expedia announced their earnings, the stock dropped. This, what's interesting about like the valuation isn't that bad. The trend is negative here, just technically. I'd say this stock has to prove itself. My bet is that this probably gets above the blue line and may well continue to head down. The trend is just negative. And this is a very trendy market, right? Things that trend keep trending in the direction they're going.
Right.
So I'm not there, but I think it's a good idea to have on a watch list, study more closely. I'm looking at this stock, HGV. I think this is interesting. 9.5 forward PE. It's owned by Hilton. But it's another travel and leisure theme. We don't own it currently. I think it's a good idea to explore the travel leisure thing. Where are the boomers spending their money?
Right.
That's a good area to focus on.
All right. This was awesome, Ram. Let me ask you one final last question.
Sure.
Do you have aspirations to be Kathy Wood level of fame, Bill Ackman level of fame? Do you want to get there over the next 20 years and manage billions and billions of dollars?
I'm less interested in fame. I care about investment excellence and performance. I hold myself to a high standard. So I'm highly competitive. I want to win. I want to compound at a 20% CAGR for a long time.
You want to beat the S&P?
I absolutely want to beat the S&P, which we did last year, and we're doing this year, and beating QQQ for that matter.
How much are you up year to date there, the firm?
So our model portfolio is 20%. Every account actually owns different stocks based on when they join. Now there's overlap. If we buy a stock, buy for everyone. But here's the thing. Clients that joined in October of last year, they own more semis because they were on sale, and I'm going to wait for long-term capital gains, right?
Right.
A client joining today, I might buy only 2 semiconductors, whereas in October, we're buying half a dozen. So that's
the way this works is if someone comes up to you and say, "Hey, Ram, here's $1 million," you just manage that million for them. It's not like an ETF or anything.
We start with investment policy statement, try to understand their return objectives, risk tolerance, time horizon, liquidity needs, unique considerations. Are they in the tech industry? That means you should maybe underweight tech. We start there and then we build up. By the way, the funny thing is, honestly, I think you can make more money on the alternative investments. When stock multiples are expensive, you want to kind of underweight stocks. When stock multiples are cheap, you want to overweight. So multiple now is 21 for PE. It's pricey. I think we finished the year. It's a bull market. But you make your money on the buy. Your entry valuation does have a significant driver long-term returns. We bought CoreWeave. CoreWeave is the Neo Cloud private deal that powers OpenAI and Microsoft. You're going to hear a lot more about CoreWeave. I learned about this in the Odd Lots podcast with Tracy and Joe, right? But we bought CoreWeave in November at a $7 billion valuation and did 3x in 5.5 months.
And that was on the secondary markets.
Yeah, we had an SPV.
Okay.
But those are the kinds that those happen fair and far in between. But that's the only SPV we've done on a one-off deal. I think distressed commercial real estate is very good. Now Blackstone's getting to that, but distressed commercial real estate should be a 4x MOIC over 10 years with tax efficiency. It's you can make good money in real estate. You want to buy low, sell high. When do you buy low? When interest rates are high. Why? Because all assets are cheap then, especially real estate assets. These are dislocated assets. They're not going to go anywhere. They'll be there. And you've got banks that want to not lose money. And so they'll auction off an asset to a buyer. So alts have an important role to play. I don't like bonds. Why would you own bonds when you can get returns in private credit that earn the teens? So, it is cross asset class. It's not, think about like an endowment. Endowment, they're not all in equities.
Yeah.
They have real estate. They have
VC,
cash flow. Yeah. Exactly. So we try to curate what is a good endowment style portfolio so you can sleep well at night and be in it for the long game.
This is the actual final question because I'm just curious about this as a fund manager. Sure. I'm assuming one day market's red. Are your clients calling or do you sometimes have to be a therapist with them? Do they sleep well at night knowing you're managing? Do you feel the pressure of I've got a shit ton of money. I better be right on Meta and Nvidia, right? For these other people.
Well, I'm always quote unquote feeling pressure. The hardest pressure comes from myself, first of all. Yeah. If you haven't noticed, I obsess over this stuff.
And you should, right? I mean, that's good if you have that pressure.
You have to. That's number one. This is a dynamic world we live in. So number two is no. I mean, for some reason, we've attracted a highly discerning, sophisticated clientele. For people that are just very humble. There are two groups. One are exited founders, so they created a lot of money in crypto. And some of them see us as we're their rotation. They're look, at the end of crypto, I'm going to rotate out and give you a boatload of these assets, and you're going to make sure that I grow and protect my wealth. That's one bucket. Exited founders and people that think originally. We have a number of clients in Puerto Rico, for example. They Act 60. They wanted to not pay U.S. taxes, get better treatment there. So people that think differently. We don't get traditional call it boomer accounts at JP Morgan so much, although we've got quite a few accounts that are ex-Goldman Sachs, which is really funny, including a Goldman Sachs executive. And they're very sharp. We learn from our clients. We have clients that created their wealth. One is in the lumber industry. I know nothing about lumber. I talked to him about the nature of the housing market. I have another client that built and sold a payments business. So he knows a lot about payments. So you learn through that interaction. Right. And you got to find people that have expertise in different areas. Try to zoom out, spot the trend. Is it priced appropriately? If it is that theme, then go deep, map the category, find the leader, do that qualitative analysis, and then wait and stock for a good entry. So it's putting all that together, stitching a nice portfolio together, and you can do well. But I haven't had like panic clients or anything like that, and that's going to happen inevitably, I guess. But you're right though, in the sense that training clients to be good clients is very important. Clients are the worst enemy. I've gotten questions from clients like, "Why'd you buy that? Or why'd you buy this?" More out of curiosity, intellectual curiosity. Sometimes more intellectually challenging.
Yeah,
they always let me do what I need to do. But when that happens, those are the best stocks, by the way. Those are the best.
right.
When no one pushes back, then you got to be worried. When everyone's excited about an idea, and it goes back to the point around Twitter and social media. When everyone loves an idea, everyone's already in. It's already baked into the price.
Yeah. Well, I know I've experienced this with Robinhood. I started buying it at $8. I was like one of maybe 3 people talking about it. Now it's at 20. There's a lot of excitement. I still think there's more room for upside, but the upside is not as big as at that $8,
Exactly. It's like a spring. The higher prices grow, valuation can pull back, but there's also this momentum component, which makes investing interesting. You have the momentum versus the rocket launch versus mean reversion, which is the rubber band, and finding opportunities. Ideally, you buy the best assets when they're on sale. So in the banking crisis last year, all the banks are cheap. What do? You buy the best bank in the land. You buy JP Morgan and you buy UBS, the number one global wealth manager. And that's it. You don't try to get cute finding other banks that might this or that. You try to find the Mercedes that's cheap.
Right.
When everything in that category is on. That's generally what we've done, finding the rotation. Energy was cheap in December. Find the best assets in that asset class. Healthcare is expensive right now. Consumer staples were cheap. Okay, what's the best asset in consumer staples? Hershey's. Let's go buy Hershey's. So I think some insurance plays are cheap right now, and that's what we're researching right now.
All right.
I
love it. This was awesome. Rom's Twitter is in the chat, guys. Please check him out. I'm sure we'll have him on the channel again later this year. It'll be super awesome to talk to you. Thank you, man. This was great. 443 people on a Sunday.
Wow. Really appreciate it. Thank you for all the content you do too. I really enjoy your content, your intellectual curiosity, and your interviews. Keep it up. Keep up the great work. Be well. Take care.
Appreciate it. Have a great weekend, guys. See you later. Bye-bye.